Richard Clarida, the new vice chairman of the Federal Reserve, will say in his first speech as vice chairman that further rate hikes are likely appropriate, that monetary policy is still accommodative. The real funds rate, that is the one adjusted for inflation, remains below neutral, saying Fed policy should aim to sustain the expansion. Now, it gets a little complicated from here because here he says the number of hikes in 2019 depends on growth, employment, and inflation, and he gives us something of a little formula here. The trouble is we're missing some key inputs. Let me tell you the Clarida formula here. He says he's going to do more hikes than he currently expects in 2019 if you have strong growth, strong jobs, and that comes with a, quote, material rise in inflation. So that's a pretty high bar. He'll do fewer hikes than he expects in 2019 if you get the strong growth, the strong jobs, but you have stable inflation. What's missing from that formula there is I don't know how many hikes he expects in 2019. Yeah. But more if there's more. What is important, though, is he sets a high bar for inflation. Let me go through some of this because there's a little bit of a dovish twinge to this.
What happens if you have weaker growth?
Yeah. Well, no, he says what he's talking about is his expectation for strong growth and low unemployment next year. But, Scott, give me just 1 second because I want to go through the rest of this. There's a little bit of a dovish aspect where he says there is scope for the job market to strengthen here without generating inflation. Goes on to say the labor market may not be as tight as he would have previously thought, so he sees the possibility for higher trend at its potential growth and lower structural or the natural unemployment rate may be lower than previously. Possibility for a pickup in productivity growth, which would be, of course, something that's not inflationary. Points out in the last two expansions, wage gains did not lead to inflation. Then there's this quote right here. The traditional indicators of cost push price pressure are not flashing red right now. So we're going to come back to that in a second. I want to tell you a couple other things on the economy. He says households are well positioned to maintain the increased consumption and says the savings rate and the tax cuts as a tailwind for the economy. So let me set the stage a little bit on this, Scott, which is that Clarida comes in. Powell is not a monetary policy expert. Powell's got a PhD in it, worked at PIMCO, very highly regarded around the country for his expertise in monetary policy. Laying out a path here, I think, for the Fed to get to neutral, which is this 2.75 to 3% range, and stop there until he sees the whites of the eyes, so to speak, of a materially higher rise in inflation. There's a certain Kudlowian aspect to this, which is if Larry said one thing after he said King Dollar, he said this, which is that growth is not inflationary. So Clarida's holding out this possibility, saying, I am not going to be freaked out by strong growth and by low unemployment. I'm going to maybe let it ride a little bit.
Is this at odds at all with how Powell himself thinks, where you can perhaps go past neutral?
I don't think so. I mean, I think Powell has also held out this possibility, just not said it in these kind of technical economic jargon. Because, you know, Clarida's an economist, also a musician, by the way, in case you're interested. Little fun factoid there. But beyond that, I'm sure, which is not relevant at all to the conversation, I'll point out he's laying out the possibility that, hey, the Fed could abide some higher growth, abide this lower unemployment, unless there's this material rise in employment. And then he'll do as many as he expects. I expect that to be one in December and maybe one or two more next year, maybe not three. And that's really, Scott, been the debate in the market. And I think you think the Fed has said they're doing three. I don't think so. I think they said they're kind of maybe going above neutral if you have this rise in inflation.